Change my background here. Good morning, everyone. Let's see. Trying to change back to my LACERA background here. Doesn't want to let me do that. Okay. All right. So you guys get the faux living room approach today. Good morning. Linda, can you go ahead and call the roll, please?
It'll be me, Mr. Jones Carroll. I'll do my opening statement. This meeting is being conducted as a virtual meeting, so I'll do a roll call of all the trustees to confirm attendance. Mr. Knox?
Good morning, I'm here.
Mr. Bernstein?
I'm here.
Ms. Sanchez?
Here.
Mr. Green?
Here.
Chair Jones?
Here.
Mr. Keough? Mr. Santos?
Here.
Ms. Greenwood? Mr. Kelly?
Present. Good morning.
Staff participating in today's meeting include Principal Investment Officer Jim Rice, Senior Investment Officer Scott Drazel, Investment Officer Amit Agril, Senior Investment Analysts Cindy Rivera and Michael Romero. Trustees, if you have a comment or question, please use the Zoom chat option. At this time, we ask all meeting participants to mute their mics until you're ready to speak. And now, Chair Jones, we may proceed with the agenda.
Okay. Now that we've had the call to order, the approval of the meetings from the September 8th meeting, do I have a motion to approve the minutes?
Keith on
So
the
moved.
I couldn't tell who that was.
Who was it?
Sanchez.
Mr.
Ms. Sanchez.
Ms.
Do I have a-
Sanchez? Okay.
Yep, a second. All right. Did you get that?
Who was the second? I didn't hear. Who
Keith
seconded
Knox.
it? Oh, Mr. Knox, okay. I'll do the roll call. Mr. Knox,
Aye.
Mr. Bernstein,
Aye.
Ms. Sanchez,
Aye.
and Chair Jones.
Aye.
The motion passes unanimously.
All right. Do we have any public comments? Anything written?
We do not
or
have any.
queued up? Okay, great.
Yeah.
To move on into the meat of the report. So I want to give everyone a heads up a little bit in terms of the flow. It's going to be a slight detour from the agenda. So we'll have our structure review report as a part as listed here in our non-consent item. Then we will make a slight detour into a executive session or closed session to go through some of the necessary content as a part of that structure review in closed session, and go ahead and advance the matters there, then come back out, complete the remainder of the structure review, and have one final kind of set of items to be advanced out or advanced forward from that perspective. So any questions at all, Jim? Did I hit that correctly? Okay. All right, so without further ado, then let's go ahead and get into item 4, the non-consent item, and then Jim, you and your team go ahead and take it from there.
Okay. Good morning, Mr. Chair, members of the committee, and other trustees. Today, we're going to be covering the structure review for the real estate section of the real asset category. The other part of real assets will be covered, which includes infrastructure and natural resources. That's going to be covered at a committee meeting next month. Today's structure review will be covered largely in open session, but as Chair Jones just mentioned, some of the material will be covered also in closed session after this session. We're joined by consultants from Stepstone Group, Margaret McKnight, who provided their concurrence with the recommendations being proposed today. And then joining the discussion from LACERA staff are Cindy Rivera, Amit Agrawal, and Mike Romero. So if we could just turn to slide 3, please. The real assets category serves 3 main purposes for LACERA. They provide a source of return coming from yielding assets. They provide a natural inflation hedge, as these returns are correlated with changes in inflation. And then lastly, they provide diversification from the key growth return drivers for LACERA that are linked to global equity markets. Next slide, please. Real estate is, unlike the rest of real assets, real estate does straddle two different risk categories. So not only does it, part of it sit within the real assets and inflation hedge category, we do have part of it now in the growth category, with the non-core segment of real estate residing in that section. Next slide, please. When we look at the risk return orientation of the core real estate within real assets, shown here in green as real assets, it resides squarely in the middle of our mix of four asset categories, next to the credit asset category. Non-core real estate is part of the higher risk, higher return growth category in the upper right. Next slide, please. Focusing on the evolution of our real estate structure, the last time that we discussed as staff the real estate structure, this was last year in the mid-cycle structure review. We did consider some potential changes to the real estate structure as part of that review. And today's presentation puts in place a recommendation to transform the structure of the real estate program in order to reduce concentration and operational risk that we currently have in the program. Should that be approved, we would intend to accomplish that by focusing the core program on open-ended funds and the non-core program on closed-ended funds. And this would move us away from a program which has emphasized separate account assets directly held by LACERA in the name of corporate entities called title holding companies. Next slide. Just to review the allocation of how real estate fits into the total fund, core real estate within real assets makes up a little under 6% of the total fund. The two other growth sleeves are value added and opportunistic. Combined, they currently make up about 1.3% of the total fund. And then there is a small residual credit allocation overseen by the real estate team that is winding down and is in the credit allocation. That sleeve is not a focus of today's recommendation. Next slide. I wanted to briefly review the changes in the asset allocation that occurred with this year's new strategic asset allocation policy that was adopted. One of the changes that occurred was we did move value-added real estate from this real assets and inflation hedges category to the growth category to reflect some of the higher returning expectations we have for that category. So core real estate remains in real assets. It currently, under the new policy, has a 6% allocation weight. And then overall non-core has really grown. Previously, it was at 2% in the prior allocation. Now with value-added assets, it is currently at 3%, but it's moving to 4% when the policy is fully implemented next year. So at this point, I'm going to pass it on to Cindy Rivera, who's going to begin the discussion about some of the structural considerations we're addressing today.
Thank you, Jim. This slide provides context for the structure review recommendations being proposed today for advancement to the Board of Investments in January of 2022. In September 2021, the board's real estate consultant, Stepstone, presented its initial findings on the LACERA real estate portfolio to this Real Assets Committee. The three main takeaways of that analysis are that 1, the real estate portfolio has underperformed over the long term against both benchmark and peers. 2, portfolio risk is high due to asset concentration and risk classification. And 3, the underperformance coupled with the high tracking error indicates that the higher risk has been uncompensated. The following slides present a proposal to help reduce both risk and underperformance. With the goal of creating a LACERA real estate portfolio that is more diversified, performing, and efficient, we propose refining our business model in 4 main areas. First, shift from a portfolio that is largely direct to more diversified, thereby reducing concentration risk in our separate account investments. Second, emphasize fund structures in pursuit of greater diversification via new commingled fund investments. To illustrate the greater diversification potential of funds, we note that across all its real estate separate accounts, LACERA holds 78 assets, while its largest real estate commingled fund has over 500 assets. Third, assess the portfolio by essentially re-underwriting the portfolio, identifying an updated wholesale strategy, and more clearly delineating risk. And lastly, we propose reducing operational risk by shifting operationally intensive responsibilities, such as cash management, to managers with greater resources and experience in this area. On the next slide, we cover the evolution of investment vehicles in LACERA's real estate program. The bottom row illustrates vehicles currently deployed in our portfolio, while the top row outlines vehicles for future consideration. We propose a primary near-term focus of making new investments largely via commingled funds, and over the long term, exploring additional investment vehicles such as club deals, REITs, and secondaries. Such investment vehicles will require time to build relationships with like-minded investors and firms entrenched in the space. REIT investments are more straightforward, but there is greater complexity in club deals and secondaries. Next slide, please. On this and the next slide, we briefly cover performance over short and long-term periods. Here, we see that core and value-added real estate has underperformed in all periods, except for a slight outperformance in the quarter and since inception periods. The underperformance is driven in part by lumpy retail investments in separate accounts that have since been terminated. On the next slide, we see that opportunistic real estate, one slide prior. Two prior. Yes. Thank you, David. On this slide, we see that opportunistic real estate has outperformed in the quarter through 5-year periods and underperformed in the longer 10-year and since inception periods. The favorable performance is driven largely by an intentional tilt into industrial and multifamily. Next slide, please. I'm sorry, one more slide. This slide covers MSCI forecast active risk for real estate. On the top left corner of the table, we see that real estate represents only 7.2% of total fund, while under the active risk contribution column, we see that at 20 basis points, the asset class is disproportionately contributing close to 20% of the total fund's active risk measured at 110 basis points. Additionally, the selection risk contribution column shows that the asset class's selection risk is driven by core and value-added real estate, which has a high standalone active risk of 5.2%. The structural changes being proposed today are designed to help bring this down. And now I will hand over the next slide to Amit, who will cover structural considerations and proposed implementation.
Thank you, Cindy. Good morning, Mr. Chair and trustees. I will now touch on the proposed structures and the liquidity provisions for both core and non-core investments. If approved, moving forward, the proposed changes for core investments will be through open-ended commingled funds, and for non-core, it will be through closed-ended commingled funds. There is some liquidity provisions for open-ended commingled funds, as one can only request for a redemption after the initial lockup period, which is usually 18 months to 2 years. The payout will then depend upon the exit queue. This may not be as lucrative as separate accounts, in which a sale can be initiated at any time. In closed-end funds, there is limited liquidity through secondary sales. The typical fund life for closed-end funds is from 5 to 7 years. Moving on to the next slide. If this plan is approved, the focus over the next couple of years will be to underwrite open-end Odyssey funds as staff continues the sale of core holdings in the separate accounts, and thereby maintaining a 6% target allocation for real estate and inflation hedges. All Odyssey fund recommendations will be brought forward to the BOI for approval. 6 to 8 Odyssey fund investments are recommended, with each commitment being around $400 to $800 million. The biggest challenge will be to manage the timing from the sale of assets in the separate accounts with the entry queue in the open-end commingled funds. Moving on to the next slide. It should be noted that the value add real estate moved into the growth functional asset class as of the 1st of October 2021. The allocation to value add and opportunistic real estate is currently at 3%, but is expected to increase to 4% in 2022. The target allocations are 2% for value add and 2% for opportunistic real estate. The proposal is to underwrite around 4 to 8 domestic, global, and international value add and opportunistic commingled funds every year. Each commitment will be around 125 to 250 million. Staff expects to reach the 4% target allocation by 2026. Moving on to the next slide. The current non-core investments are at around 1.3% of the total fund. On the non-core side, all new allocations expected to be via commingled funds. The proposal is that there will be no new separate account commitments in the non-core space. The growth allocation of 4% is expected to be reached by 2026. We will skip over the next slide and move directly to slide number 21. Currently, there is only one emerging manager program in the real estate program. Staff is proposing an RFP for an emerging manager advisor in 2022. The intention here is to create a custom portfolio of emerging manager funds, mostly in the non-core, and to be consistent with LACERA's emerging manager policy. Now I would like to hand it over to Mike to cover the strategy. Thank you.
Thank you, Ahmed. If we can please go to slide 23. Good morning, Chair Jones and trustees. We are seeking core investments to continue to help produce income while diversifying the fund. We intend to use core funds for beta exposure to the benchmark with tilts in industrial and multifamily and niche sectors such as life science and storage. We'll also be looking for non-core funds for alpha-seeking returns. We intend to accelerate the pace of commitments. We want to build on what we've done already in non-core by continuing to invest in opportunistic funds. Next slide, please. These two graphs show our core portfolio and compares it to our benchmark, which is Odyssey. Odyssey stands for Open-End Diversified Core Equity. It reflects lower risk investment strategies, utilizing low leverage, and generally represented by equity ownership positions in stable US operating properties. The chart to your left shows our property type, and the focus will be to maintain an overweight to industrial and consider a slight reduction to apartments to get closer to Odyssey, while maintaining an underweight to office and retail. The chart to the right shows how we're diversified, and we're recommending maintaining tilts to the west and south. We currently have some non-US exposure in the core space. However, the benchmark does not include any non-US exposure, but we intend to have some in the non-US as a small limited amount as a diversifier where we think there may be attractive opportunities in this space. Next slide, please. The majority of the investable universe is outside of the US. We are recommending using fund structures which will allow us the expansion of the non-US exposure. Our program has been mainly focused in the US with limited exposure outside. This is going to be a bigger piece going forward. As our non-core grows, we would like the non-US to be more representative of the broader opportunity set. Next slide, please. These two charts show our non-core diversification by property type and region. Non-core will progressively become a larger part of the real estate allocation. I'll point out that about 36% of our total non-core is outside of the US, highlighted in yellow. We're seeking to invest in closed-end funds that will provide diversification by sector and geography. This is designed to be more opportunistic part of the portfolio. Next slide, please. Here we're showing proposed guidelines. These are largely unchanged for the core. We do have a few modifications. The real estate guidelines we had in place were largely oriented more towards the core portfolio, and we intend to maintain much of this with slight modifications. We did expand some of the larger property sectors like apartment, industrial, and office to be more underweight in retail. We added a 30% limit fund concentration that we didn't have before, as we are relying more on funds. Next slide, please. This shows our proposed guidelines for non-core. These are largely new guidelines for this area. We have to be more of an opportunistic space as opportunities arise. So we have to be somewhat flexible when we target
Move back. Good
when we
boy.
target investments outside of the US. We seek to provide some framework that provides appropriate diversification in the structure. We propose a 4% allocation. Property types ranges have been outlined. And we're also seeking to have a range of 35 to 60% of non-core in the US. The non-US we have includes ranges in Europe, Asia, and emerging markets to have latitude when opportunities arise. I will now pass it on to Jim, who will continue with the presentation.
Mr. Chair, can I ask a question at this point? Well, Mr. Romero?
Yes.
Well, I gotta go. Okay, thank you.
I'm sorry.
A couple of things, Mr. Romero. I noticed here that non-US geographic, it shows Europe, Asia, and then emerging markets. So are we saying that there are some countries, let's say like China, who are already considered developed markets as compared to the emerging markets? That's my first question. The second question is, how do we quantify the income coming out of the commingled funds? So, we have rental income and things of that nature. How is that quantified? I get it from separate accounts, right? But I'm not getting it in terms of, I'm in favor of commingled funds, don't get me wrong. I just wanted to learn how we quantify the, I guess, monthly revenue or quarterly revenue that we get from rents and things like that. Do you understand my question?
Yes, I'll touch on the first one. As I mentioned earlier, the investable universe outside of the US is relatively large. We are exploring opportunities in emerging markets. We've added a range of 0, I believe it's 0 to 15% in the non-core to give us flexibility to enter those markets as we see when opportunities arise. And then your second question.
I get that before I let you go, before I let you proceed. But my question was, we have Europe, non-core, right? Growth, non-core. We have Europe, Asia, and other, okay, I got you. Other emerging markets, got it, never mind. It's right here in front of me. Okay. Thank you.
And I think your second question was about income when we are investing in funds. So core income is a big part of the core strategy. Core usually represents stabilized assets that are generating income. So we expect to have some distributions from those funds. So that's where the core component will be. The income component will be coming from those funds.
Yes, we wouldn't expect to see large income components coming from non-core, given the structure that we're in. Largely, these would be, properties that require some kind of redevelopment or, some capital contribution that would be, ultimately sold, and that's when I think most of the realizations would occur in non-core. There is some element of return coming from non-core, but really most of it is coming from increased asset values after some redevelopment.
Right, so when we're talking about industrials, so they generate some type of revenue, income, in addition to the improvements that we would be made. So if it's an industrial, let's say a warehouse, that is obviously operated by somebody and used for some purpose, and they will have to compensate the fund for the use of the property. So that's, to me, that's rent. So how would that, my question is, how is that quantified in a commingled fund, right? Because there's several of the investors in there, and prorated, is that how it works? How is that quantified in terms of calculating our returns?
Yes, so these funds would pay out, part of the return would come out as income from rents, but really most of it in a non-core, particularly on the opportunistic side, is going to be coming from later on in the cycle when these assets are sold. So there could be a small element from return coming from current yield in non-core, but it's small compared to what ultimately we expect to realize for these investments.
I appreciate your answer very much. Sorry, Mr. Chair, I don't want to belabor the point here, but historically, the real estate consultant used to make a big deal about rents coming in when I used to question the underperformance. So this is welcome news, and thank you for your explanation. I appreciate it. Thank you, Mr. Chair.
Absolutely. Go ahead, Mike. Did you in your flow there?
No, I was going to pass it on to Jim to continue with the presentation.
Okay.
Okay. So Mike covered some of the guidelines that we are putting forth as a proposal for the new structure for both core and non-core, reflecting their different roles in our program. We have an additional consideration to be considered by the board or by the committee to advance, and that is to incorporate a delegated authority to the CIO to approve re-ups for previously approved fund managers that meet certain criteria. These follow the parameters that are already in place for private equity. The delegated authority proposed would allow that if the fund commitment is under $250 million or up to 25% larger than the prior fund commitments, then that would be subject to delegated authority. It would also require that the prior fund has achieved at least median performance for IRR, and multiple of invested capital. Next slide, please, David. A summary of what the initiatives completed in the real estate category include the onboarding of the administrator role and the performance book of record, which have been done by State Street that came on this year. We did onboard a new consultants relationship to Stepstone that also occurred this year. As far as what's in process, we've listed here, in addition to things under consideration today, some of the ESG related initiatives in progress. Those are going to be discussed further in a separate presentation at this meeting. And then as far as upcoming initiatives in place, these include the starting up of the efforts to underwrite Odyssey core funds and ramping up the underwriting of non-core real estate funds. So turning on to the next slide, the recommendations. We will come back to review these full recommendations, which reiterate the fund pacing just mentioned after we hold the closed session discussion, which includes some additional items. So at this point, that concludes our comments for the open session. We can move into closed session if the committee chair would allow, or we can take questions as well.
So yeah, let's take a pause real quick here. Are there any questions prior to, I see Trustee Knox?
Yeah, quickly, and thank you for the information, Jim, John. I don't know if this question is for either of you, but is there any impact to your staffing resources or capacity with all of these changes?
I think the team we have authorized for the real estate team is sufficient to achieve what we intend to accomplish with these recommendations. We are understaffed right now. We do intend to fill some of the positions that we have authority authorized. So I think once they're filled, we'll be in a better position to accomplish this, and we'll be sufficiently staffed with the authorized positions again.
Because it seems like a good plan. I just want to make sure you're properly resourced and staffed for that.
Hey, John, did you want to take a moment perhaps and also give the committee an update? I know that there's Jim has had the dubious battlefield promotion of being the interim lead from the real estate side. Do you anticipate a replacement, a permanent replacement, or what do we see from the ultimate leadership role of the real estate group? Can you give us an update?
Yeah, and once again, I'm sensitive to talking about personnel matters in open session. We've been moving more towards a functional org chart to align with our asset allocation, where if we have a growth bucket, we've had co-heads where the then PIOs have partnered to oversee the component parts of it. But we've also had single PIOs oversee various functional categories. For example, Vache oversees several. The real assets we have combined, and Mr. Rice, there is no interim title on his part. He is the principal investment officer for all real assets. So we do have open vacancies within real estate, and going back towards Mr. Knox's question, I think Jim answered it perfectly in that we will have sufficient bandwidth to accomplish this plan once those positions are filled.
Thank you, John. And then I think Herman or Trustee Santos, did you have another question?
Yes, and my question is to our consultant, the Stepstone. Are they on the line?
Yes, Tom Hester and I, Margaret McKnight from Stepstone, are on the line.
Good morning. So my question to you is that the staff is proposing up to $250 million rather, delegate authority to the CIO. In your view, is that sufficient? This is real estate. I get it with regards to private equity. I think that it might be too low for real estate. Would you care to comment on that?
We designed the ranges to be flexible to allow for multiple managers and a little more diversification and effectively hit the targets within the means of the team. So I do believe we have, if we make enough commitments that we can do at that size level, we will hit the targets.
No, but my question was, the staff is proposing to provide delegated authority to the CIO up to $250 million. My question is that sufficient? It appears to me that it may not be. I thought that maybe 500 million will be more appropriate delegated authority.
Well, that is per fund, and that's the approximate range that we were thinking that individual fund commitments would be.
Yeah, it's not atypical at that range for a fund of this size, a plan of this size.
Okay, so I'm not quite convinced with that because I understand the ranges. I just want to make sure that the CIO has enough flexibility to invest or re-ups. That's it appears to me it's not, but I'm not an expert in real estate, so I just want to make sure that we are given the sufficient amount of money for the CIO to take advantage of those opportunities that might come his way. It appears to me that the $250 million is too low. But
Mr. Santos, I might just add, I think unlike private equity where they have over 100 fund relationships from which to consider re-ups, we've had much smaller exposures to the number of funds that we would consider re-upping with. I think we have maybe a dozen non-core funds that could be considered for re-ups. So I think, in the interest of expanding the manager universe as we grow the non-core allocation, I think 250 would be really the maximum we would consider even for existing relationships.
Great, thank you for that.
We're really trying to expand the pool of managers as well.
Thank you, appreciate it.
All right. Any other questions from the trustees or otherwise before we detour into executive session? All right. So, Julie, getting an executive section, who needs to be into that meeting? Could you prep us for?
Yeah,
for
I'm
that?
just gonna have to move some of the consultants. It'll just
Yep.
take me a couple of minutes. I'll be right back.
No worries.